Many traders are not leveraging the most that they can leverage out of analysis and forecasting because they don't understand the two. In today's video, guys, we're going to get into what analysis is and what forecasting is. Not only are we going to differentiate the two, but we're also going to go into helpful tips and helpful ways that you can maximize on the use of both your technical analysis and your forecasting. Now let's get into things, guys. We're going to start off with our differences between number one, analysis and forecasting. Now to kick things off, guys, we're going to need to draw this illustration so that I can show you guys what analysis and forecasting is. Now all analysis is us looking at the chart, observing the chart, and coming to a conclusion with a given rule set. So analysis is looking at our chart and coming to a conclusion on what the chart is telling us. What forecasting is, on the other hand, is forecasting is taking this information that we've concluded from the chart and then predicting future price movements. Now that we know the differences between analysis and forecasting, we're going to start off with breaking down analysis. Now, number one, guys, analysis deals with a systematic approach. Now, if you guys don't have a systematic approach to your analysis, I would suggest that you go and watch our video, 4 steps to systemize your analysis. Now, that video will obviously go in depth on how you can systemize your analysis. So the number one point is that analysis deals with a systematic approach. We need to have rules that define every single thing that we are going to do. We need to restrict the amount of time frames that we're looking at. We need to have concepts that we use to derive information. All of that nice good stuff, guys, will be explained in that video, the 4 ways to systemize your analysis. Now let's go on to number 2, guys. Number 2, everything should be concluded using logic and reason. Now, what do I mean by that? All I mean, guys, is that every conclusion that we come to during our analysis should be concluded based off something objective that we can see on the chart. So absolutely no guesswork, guys. Things that we can see objectively on the chart are what allow us to use logic and reason. So first of all, we need to be able to see something on the chart. Next, using logic and reason, we need to make sense of the information that we are seeing on the chart. How do we make sense of this information? Is if we have defined rules as to what pieces of information we are going to take in. If we're going to look at horizontal support and resistance, if we're going to look at structures, if we're going to look at, I don't know, impulsive moves, the momentum, we need to have a defined set of things that we are looking for on our chart. Once we have those defined set of things, we're able to use our objective chart structure to then piece together our individual concepts and things that we look for using logic and reason. Now, once we have that logic and reason aligned, number 3, guys, analysis involves building a story. Now that we have all of these pieces of information that we've been looking for, we have our momentum, we have our horizontal support and resistance, we have our structures isolated. Now that we have this information, we need to build a story. A story would go as such. We have momentum coming in from the upside, obviously showing us our impulsive structure. We have a corrective structure, obviously showing us our impulsive corrective normal nature of the market. After an impulsive corrective nature of the market, what do we normally expect? We normally expect a continuation of price in the direction of the initial impulse. So what we are doing is using our objective things that we are looking for, obviously logic and reason to put them together, and then we are building a story. Building this story involves our theoretical knowledge. So we use all of these individual pieces of concepts to put together a story with the theoretical knowledge or experiential knowledge that we have trading these particular assets. Now we'll go on to forecasting, guys. First thing, most important thing about forecasting, guys, and this is the absolute gem, the absolute nugget of forecasting, guys. Forecasting only requires two main pieces of information. Number one, all we need is an identifiable call for action. What do I mean by that? Now let's get on to drawing our same example that we had there. What we'll say is that price is at this price region here. We have important resistance, we have important support, we have our impulsive move to the downside, and based off the story that we are looking for, we are now going to forecast the market. Remember, number one, I said we need an identifiable call to action. What do I mean by that is that we need something objective to happen on the chart that will give us reason to look at this pair as a pair that will give us a setup. So what I mean by our identifiable call to action is that we need to have a system in place. We need to have a story that says we're looking for our next impulsive move to the downside. Our forecasting needs an identifiable call of action. What an identifiable call of action would be for me and the way that I trade is for example, reversal structure. That gives me a pattern that gives me a reason to take a setup in the direction that I'm looking to trade. So we need an identifiable call to action, whether that's an ascending structure, whether that's some sort of reversal structure, anything, any market structure that will give us a reason or warrant us to begin to look for that sell. That is our identifiable call to action. Now, number two, we need a directional bias. So that's the only two pieces of information, the only two necessary pieces of information that we need to involve in forecasting. We need an identifiable call to action, which is in this case a reversal structure or an ascending structure for me, and then we need a directional bias. Once we have those two things, we are now forecasting. Those are the only two pieces of information that we need during forecasting. Number two, guys, forecasting is not factual. There are no facts involved in forecasting. Forecasting is us using the story that we've built, using through our analysis and concluding what the theoretical or expected outcome of the story that we have built could be. So forecasting is absolutely not factual. There are no facts. Forecasting is as good as guessing the direction, but what forecasting does is that forecasting helps us with preparation. We have now primed our mind, we have now primed our brain to begin to look for structures that we are looking for to take this potential sell, given the story that we've built during our analysis, guys. Number three, we'll go on to the last point about forecasting, guys, and that forecasting is only done once our analysis is complete. Guys, I've seen a lot of people that send me charts with, I don't know, probably one trend line, and this one trend line, they have something like this done where maybe they're expecting something like this, and then a continuation structure and another continuation structure, and they have all of this drawn in over there. Guys, something like this is called ridiculous forecasting. Reason why is because, guys, forecasting is not factual. We can only go so far. We don't need all of these pieces of information for us to be able to make that next trading decision. Why? Because the way the market will deliver us price action will probably not be exactly the way we're expecting that price action. And if we are specific to this degree in our forecasting, what this will do is this will close up our mind's eye to begin to look at this market with a fresh look. And obviously, we'll then begin to miss simple, nice, clear opportunities, expecting market to give us a head and shoulders when the market is actually just going to give us a double bottom structure and reverse straight away. So what forecasting like this does is that it really honestly closes up your mind to really be open to the market developing. So what we want to have is we only want to forecast after our analysis is complete. Remember, our analysis needs to be systemized. Our analysis obviously needs to, let's just double check that. Our analysis should be concluded using logic and reason. And number 3, obviously, our analysis involves building a story. Once we've done all of those 3 steps, then only can we move on to the next step, which is our actual forecasting. So forecasting can only be done after analysis is done. And the difference and the best thing about forecasting is that forecasting involves us in the market development. After we've forecasted, now what we're doing is we're testing the integrity, guys. And this is the absolute gem about why forecasting is so important and why everyone should do forecasting, is because once we've completed our analysis, forecasts test our integrity of the analysis. We get to see, we have data that we can document in our forecasting, because obviously after we forecast, we need to document our forecast, maybe take a screenshot, maybe leave it on your charts until the move has happened, so that we see how the market has actually responded to our analysis, because that's what our forecast is. Our forecast is our expectation of what we think price should do after this story that we've built during our analysis. So what our forecasting then does is that it gives us insight to see how the market reacts to our forecast. Does the market give us that reversal structure, give us a nice impulse in the direction, give us those continuation structures, and then violate our lower structures there that we anticipated it to violate? That's what our forecasting gives us insight into. It involves us into the market and gives us that experiential knowledge, guys. Nothing can buy that experiential knowledge. You can only get that by involving yourselves into the markets, and forecasting allows us to do those types of things. Now, guys, I hope that you actually have now seen the difference between analysis and forecasting, and only after you know the difference between the two will you be able to leverage the full power of technical analysis and the full power of forecasting. Now that your mind can quantify what values you're getting from forecasting, you can now focus on just restricting your forecasting to these set of rules or to this guideline, and then leverage the most out of your forecasting. Now that you know what analysis is, you can leverage the most out of your analysis. Guys, hopefully you've received the value that this video was intended to give you. And obviously, if you have received the value, definitely do drop this video a like. It will show me that I am creating valuable content for you guys. And otherwise, guys, if it's your first time on the channel, definitely do subscribe, because I do come out with content like this every single week. Otherwise, guys, this is T.Mayne, your FX Chasers mentor. Appreciate you guys for watching till the end. Cheers. I'll see you guys in the future videos.